Hi. So in my previous video, I talked a bit about venture fund portfolio construction. I dove right in deeper into Excel. This one, I just want to go a little bit step back in terms of like what portfolio construction actually means. Now, I model venture funds in a variety of ways, and one of the free models I detail out all the different models that I have for modeling funds. And they go from really simple to really more complex ways to do it. At a simplest basis, portfolio construction is basically trying to create an assumption, a set of assumptions to figure out where is your capital being invested and what's happening in the portfolio over time, right? And associated details in terms of the companies you invest into, what your expectations of their future are, to inform your future pro rata, whether you invest in the future rounds, but also understand what your potential exit value and proceeds could be from those investments. And so one simple way to model a fund is basically to start with just do like an overall capital. So you're going to invest a certain amount. You're going to create a $25 million fund in terms of committed capital. You're going to call that full $25 million. Out of that, you're going to pay fees to operate the fund. You're also going to pay fees to manage the fund and to pay it to the management company. That leftover is effectively investable capital. Investments, then you put money in, you get money back out in terms of proceeds. You create some logic in terms of what that link between investments and proceeds in. Oftentimes, portfolio construction is that link. Out of the proceeds, some of them we distribute to the LPs, some of them distribute to GPs, oftentimes through carry. So portfolio construction can be done in a very, very simple way. So you come to this idea of how do I forecast out how much the fund actually makes. Very simplest way is just to say, hey, I invest a certain amount. I invest $20 million of capital. I earn a 3x gross return. I get $75 million of proceeds. Out of that, I pay my carry. The rest goes back to LPs. GPs get the cut. That's a very simple way. There's two, if you want to get more complicated and detailed about that, there's effectively two different paths to kind of go down. In my most complicated models, I go down both paths, right? In different models, we go one path versus the other. The one added level of complication is to add on time, right? As a function of time, you say, okay, well, if I'm investing this amount of capital, what does that mean in terms of cash flows over time, whether per year, per quarter, where that time frame is, over the full fund lifetime? When does actually capital calls happen? When does your management fees come in over time? When do investments come in, follow on capital? When do my proceeds actually come back as well? And you need that sort of thing to get a really detailed look at, time-based return metrics like IRR. That's one path. The other path is basically to say, okay, well, if I'm investing this amount of like $20 million of capital, what's happening to the investments I make into? Of that amount of money, how much of it is going towards individual investments? And what am I getting for that? So this is where we come to the idea of, okay, well, making assumptions around the average investment or average set of investments that I'm doing. In my basic models, I usually have some bit of a structure which says, I come with the idea of like what total invested capital is going to be. And then I have some allocation, some assumed allocation between new checks or money that's allocated put in new companies versus follow, or capital is being saved to invest into follow-on rounds from the companies that are raising kind of future rounds and are offering me the right to do pro rata. I usually assume like a check size, and it usually comes out to the idea of like total checks and total investments. Now, the simplest methodology from that, you can use that kind of stuff and not really get into details in terms of what happens in the follow-ons. And you can make a simple set of assumptions that says, hey, there's a certain time for follow, or maybe a different return multiple for follow versus new, and that kind of conflates like the total as well. Now, when it comes into portfolio construction, what I really try to do is get a little more detailed. And so in one of my more complicated models, when I'm doing portfolio construction, I'm basically trying to say, okay, what's happening if I'm putting this money in? What's happening to this company over time? Usually, what that means, I'm making some set of assumptions around what my initial investment was, some calculations around how much capital can I put into kind of future rounds from there, and then I'm doing that in some expectation in terms of proceeds when it happens, and then underlying change of the portfolio over time, right? So the core set of assumptions are necessary to do like a portfolio construction like that is usually make some assumption over a set of rounds, right? And then you probably make some assumptions over what those rounds are, right? So if you're putting money in your first check, you're gonna make an assumption of like what's the total amount raised, or capital they're raising from, as well as what the post-money valuation is going to be. You're going to make that effectively that same assumption then go on. You can add in complications around option pools, so extra dilution happens from that, those sort of things. What you're really trying to get to at the end is, what does your dilution look like over time, right? What is your ownership percentage as each additional round happens? and then your expectations in terms of what the exit value is going to be to figure out, well, if you own this much, you dilute it down, this is how much your actual investment is going to be worth at this point in time. And so the second set of assumptions that are really kind of key to that is this idea of like a graduation rates. Effectively, companies that graduate to kind of future rounds. So usually I structure this in a way that says, hey, for each individual round, what happens after each round? Some of them raise the next round, some of them fail, some of them are written off essentially, and some of them exit for some amount. And so I make an assumption here to say, okay, well, if they exit before the next round, what do they exit for? And I come up with some logic that usually creates an exit value that's between the value of the last one and the value of before the next one as well. If they exit, I usually just say they get 0. And I do that sort of a logic all the way through to give it some assumption of what percentage of companies actually go through these rounds. Now, in this construction, it ends up with effectively a chart like this, which says, I have a certain number of companies. Some of them continue to raise kind of future rounds going forward, and I'm left with a certain number of companies at kind of the end. Now, I'm earning proceeds all along the way. And that's kind of one of the keys here, is that it's not, you can model this saying simply, hey, I put $1 million into a company, 5 years or 8 years later, I get an average of 3x. And that's fine. But what actually happens in reality is there's a lot more variation and change under the hood. Like some companies are going to fail, somebody's going to exit for smaller amounts earlier on. So you may achieve that 5x proceeds. The more detailed way to model that is to say, well, maybe I'm going to get a 5x overall, but that 5x may come in at different times. And so based upon this structure of assumptions, this graduation rates, allows me to actually look to say, okay, well, of that total 5x, when does it actually happen? So I make this assumption around a time to exit, which creates an average holding period effectively for at each iterative round. And I basically look and say, okay, well, of a company of the total companies I invest into, what percentage of them are going to exit this round? We're going to exit this round. We're going to exit this round. What are going to exit this round? And based upon my expectations of the increase in the rounds, what am I going to earn each one of those? And what I do is it creates an overall estimate of effectively like a share of the total overall proceeds that are earned at each round. And I use that to do a bunch of underlying calcs around change in invested capital, meaning how much of the capital I invested is still invested, hasn't been written off. Any changes in unrealized gains basically has the value of my investments change over time, as well as value of write-offs. And to get an idea, I'm trying to track this idea of like residual value. What's the value left in the portfolio over time? And that's this is a methodology here, which is one way to do it. But effectively, I'm trying to say for $1 capital, what actually happens over time. And that gets applied to a portfolio forecast in terms of total capital being invested to kind of create this estimate from it. And that's one way to do this, obviously, right? The more detailed, you can also, the even more detailed way to do this is to just say, here's the set of 20 investments I'm going to make, and here's what happens in them over time. I don't always do that approach. I see the value and the specificity from it, but I will say that the precision doesn't make it more accurate, and it can become more difficult to kind of model a fund that way. You have to make a ton of, you're usually going to have a big picture idea of what you want it to be, and you're going to have to make a ton of little assumptions to get to a big assumption overall. It becomes really tough to kind of manage. But also you're going to have to make little assumptions in terms of when specific things happen. And when you make little assumptions in terms of when big exits happen, can have a big impact on driving overall returns. So instead of introducing that variability in the model, I try to average things out. So I think it reflects a more average approach. In reality, things are a lot more spiky. But this idea of portfolio construction is one of the key components to a lot of the models I build. And then I try to build charts that says, hey, here's what my ownership percentage goes down over. How's my ownership percentage changes over time? What does my average investment per company look like? What does my application new and follow look like? And just it becomes valuable in being able to show the strategy behind your thinking. So it's a lot more just, hey, I'm going to invest a certain amount of money and get a certain amount back at the end. But it's some idea for someone to understand the strategy you're actually pursuing, and then demonstrate you understand kind of benchmarks and process and structures for that. So there's other models out there in terms of how to do this. On my site, other places, I have a list of different models out there that are really great to use for portfolio construction. If you have any questions on this stuff, happy to help anytime.